The poor man's covered call PMCC is a bullish options trading strategy that aims to reduce the margin requirement and maximum loss potential of the traditional covered call strategy. The PMCC strategy replaces the long stock with an in-the-money call option purchase in a long-term expiration cycle, thereby reducing the capital margin requirement of a traditional covered call. In a traditional covered call, an investor buys 100 shares of stock and shorts, writes an out-of-the-money OTM call option against the shares. However, buying 100 shares of stock requires significant investment. In a PMCC, the 100 shares of long stock are replaced with an in-the-money long call in a longer-term expiration cycle than the short call. Buying an in-the-money call option requires less capital than buying 100 shares of stock, reducing the margin requirement and maximum loss potential of the strategy. To set up a PMCC, a trader will buy a deep in-the-money call option in a long-term expiration cycle 90+ days to expiration, or DTE, as a guideline, and short an out-of-the-money call option in a near-term expiration cycle, fewer DTE than the long call. The PMCC is technically a diagonal debit spread, which is a call spread with options into different expirations instead of one expiration, which is the case for a vertical spread. The PMCC allows options traders to gain similar exposure to a covered call at a fraction of the cost of a traditional covered call position. However, it is important to note that the PMCC is not a risk-free strategy. It is subject to early assignment risk, which can lead to unexpected losses. Additionally, there are tax implications when trading PMCCs. The poor man's covered call PMCC strategy has its own set of advantages and disadvantages. Here are some of them. Pros: generates income, reduces the cost basis of stock ownership, provides a small amount of downside protection. Cons: profit potential is capped if the stock rallies. Substantial losses can occur if the stock price plummets. The strategy is subject to early assignment risk, which can lead to unexpected losses. There are tax implications when trading PMCCs. It is important to note that the PMCC is not a risk-free strategy. However, it allows options traders to gain similar exposure to a covered call at a fraction of the cost of a traditional covered call position.